Have you ever wondered how the invisible force of compound interest could completely transform your financial destiny over the course of your life? Often described by great financial minds as the eighth wonder of the world, compound interest is not just a mathematical formula. It is a powerful wealth-building engine that behaves very differently depending on which financial level you are currently on. Whether you are a beginner just starting to save your first $1,000, an intermediate investor looking to accelerate your portfolio through consistent contributions and dividend reinvestment, or an advanced wealth builder maximizing tax-advantaged accounts and leveraging assets to manage millions, understanding this mechanism is the difference between working for money and having your money work for you. Today, we are going to explore exactly how your life, daily habits, and overall net worth evolve at every single level of compound interest, revealing the exact milestones you need to reach to make this exponential growth work in your favor and secure your ultimate financial freedom. Part 1: The Foundation. The beginner stage of saving the first $1,000. Building wealth begins with a single step, and for beginners, that initial milestone is accumulating your first $1,000. This amount is not just a random number. It serves as your emergency fund and your first taste of how money can generate more money when placed in a high-yield savings account or a basic index fund. At this stage, the absolute return from compound interest may seem negligible, often amounting to only a few dollars a month, but the psychological and financial shift is monumental. You transition from living paycheck to becoming an asset builder, creating the crucial habits of discipline and delayed gratification. By saving this initial capital, you create a buffer that prevents you from going into high-interest debt when unexpected expenses arise, which is the true destroyer of compound interest before it even begins. To understand how this works in practical terms, consider what happens when you deposit $1,000 into an account earning a modest 4.5% annual yield. Over the course of the first year, you will earn around $45 purely in interest without having to lift a finger, which is equivalent to receiving a small raise for doing absolutely no extra work. While $45 might not sound like a life-changing sum, it represents the foundational blueprint of the entire financial machine you are trying to build. The key to mastering this level is realizing that compound interest is a percentage game, and the math remains exactly the same whether you have $1,000 or $100,000. You are training your mindset to let your money work for you, proving that even the smallest balances can trigger the compounding effect. Taking actionable steps at this stage requires looking closely at your monthly cash flow and identifying areas where you can trim unnecessary expenses to accelerate your savings rate. You should prioritize opening a high-yield savings account rather than keeping your emergency fund in a traditional bank account that offers virtually 0% interest. This simple choice allows your money to grow passively while remaining highly liquid for genuine emergencies. By setting up an automatic monthly transfer of even $50 or $100 directly from your paycheck into this dedicated account, you remove the temptation to spend the money before you have had a chance to save it, establishing a reliable rhythm for continuous growth. Moving past this foundational stage also involves understanding the opportunity cost of every dollar you spend on non-essential items. When you choose to invest your first $1,000, you are not just saving money for a rainy day. You are purchasing the foundational block of your future wealth. The hardest part of the entire compound interest journey is getting the flywheel to start turning, and this initial $1,000 is the friction you must overcome. Once you have built this reserve, the psychological barrier breaks, and the journey from a beginner to an intermediate investor becomes significantly clearer. You start viewing every dollar not as a means to purchase temporary satisfaction, but as a seed that, over decades, can grow into a massive financial oak tree. Part 2: the acceleration, consistent contributions, and dividend reinvestment. Once you establish your initial financial foundation, the next phase of compound interest involves accelerating your growth through consistent monthly contributions and reinvesting your earnings. At this intermediate stage, the money you save is no longer just a static safety net, but an active participant in your wealth-building journey. By adding new capital to your investment accounts on a regular basis, you feed the compounding machine, allowing it to generate returns not just on your initial sum, but on the new funds you inject every single month. This approach creates a flywheel effect, where your portfolio size increases much faster than it would if you relied solely on the initial amount. The true accelerator in this phase is the mechanism of dividend reinvestment, which functions as a secondary engine driving your compound growth. When you invest in dividend-paying stocks, mutual funds, or exchange-traded funds, those assets pay you a portion of their earnings on a regular basis, usually quarterly or monthly. Instead of taking this cash as income, setting up your account to automatically reinvest these dividends means you are purchasing additional shares without spending any extra money from your paycheck. Over time, those new shares generate their own dividends, creating a compounding loop where your money works harder and smarter for you with every single payout cycle. Taking actionable steps at this level requires setting up automated investment schedules directly linked to your paycheck. You should configure your brokerage account to automatically buy broad market index funds or blue chip stocks on a weekly or monthly basis, regardless of where the market is trading. This strategy, known as dollar cost averaging, removes the emotional stress of trying to time the market while ensuring that your capital is constantly compounding. By consistently routing a percentage of your income into these accounts, you establish a system where your investments grow silently in the background, minimizing the temptation to make impulsive purchases with your extra cash. Understanding the math behind this stage reveals why many wealth builders see their portfolios skyrocket during the acceleration phase. If you have a portfolio generating a modest dividend yield of 2% and you continually add fresh capital each month, the growth curve shifts from linear to exponential. The compounding interest generated from reinvested dividends, combined with your regular additions, means your wealth begins to outpace your active labor. As the gap between your contributions and the returns generated by the investments narrows, you reach a tipping point where the portfolio generates more value in a month than you could ever save in a year from your salary alone. Part 3: the snowball effect. Crossing the $100,000 threshold. Crossing the $100,000 mark represents a major turning point in the compound interest journey because the growth of your portfolio begins to outpace the money you can contribute from your active income. At this stage, a standard 7% annual return generates $7,000 a year, which is nearly $600 per month just in passive growth. This is the moment where the snowball effect becomes visible to the naked eye, transforming the mental image of compound interest into a tangible financial reality. The sheer weight of the capital working on your behalf means that market fluctuations will result in daily gains or losses that dwarf your monthly savings rate, which requires a shift in psychological tolerance. To fully grasp the mathematics behind the snowball effect, consider the difference between reaching your first $100,000 and the journey from $100,000 to $200,000. While the first phase requires immense discipline and years of personal sacrifice to build from zero, the second phase happens much faster due to the base effect of compound interest. If your portfolio grows at an average rate of 8%, crossing the six-figure mark means you are earning over $8,000 in the very first year without contributing an extra dime. The compounding operates like a snowball rolling down a hill, picking up mass and speed with each passing rotation, meaning the distance between significant net worth milestones shrinks dramatically over time. Taking actionable steps at this level involves managing your emotions and resisting the urge to make drastic changes to your investment strategy just because your balance is higher. You should focus on optimizing your asset allocation by ensuring your portfolio remains diversified across index funds and asset classes suited to your risk tolerance, rather than chasing speculative trends. Additionally, you must avoid the temptation of lifestyle inflation, a common pitfall where people begin spending more simply because their net worth looks impressive on paper. By maintaining the same frugal or balanced spending habits that got you to the six-figure mark, you allow the snowball to keep rolling without losing momentum to unnecessary expenses. Looking at this threshold from a long-term perspective, crossing $100,000 serves as the bridge between working for your wealth and having your wealth work for you. At this scale, the tax efficiency of your accounts becomes paramount, as a higher balance means dividends and capital gains can create a noticeable tax drag if held in standard brokerage accounts rather than tax-advantaged ones. You must review your investment vehicles to ensure you are minimizing unnecessary fees and keeping your money protected from unnecessary tax burdens. Reaching this milestone proves that the system works, empowering you to scale your goals from $100,000 to the millions, setting the stage for the next phase of financial independence. Part 4: The Wealth Builder. Maximizing tax-advantaged accounts. As your net worth continues to climb, the difference between building wealth and keeping wealth heavily depends on understanding and utilizing tax-advantaged accounts. In the United States, utilizing accounts like a 401k, a 403b, or a Roth IRA acts as a protective shield for your compounding money, preventing taxes from eroding your returns year after year. If you are holding large sums of money in standard brokerage accounts, capital gains taxes and dividend taxes take a significant cut out of your earnings before you can reinvest them. By shifting your contributions to tax-advantaged or tax-deferred vehicles, you allow the entire sum to compound without immediate tax liabilities, effectively giving your wealth a massive boost in velocity over a long period. For the year 2026, the elective deferral limit for 401k and 403b plans is $24,500, allowing a massive amount of capital to grow shielded from the IRS, while the contribution limit for traditional and Roth IRAs is $7,500. For individuals aged 50 and over, catch-up contributions allow you to put away even more money, reaching up to $32,500 in a 401k and $8,600 in an IRA, or even higher if you qualify for the super catch-up at ages 60 to 63. Taking actionable steps means you must assess which type of account works best for your specific tax bracket and retirement timeline. If you expect your income to be higher in the future, prioritizing Roth accounts allows your money to grow tax-free, whereas traditional accounts offer an immediate deduction on your current tax burden. Taking advantage of these accounts requires you to set up automatic payroll deductions, ensuring you hit the maximum contributions before you even see the money in your checking account. Many intermediate and advanced wealth builders make the mistake of leaving money on the table by not contributing up to the employer match in a 401k plan, which is essentially free money that instantly compounds. Once the match is captured, the next step is spreading out your investments through diversified index funds or mutual funds within these accounts. The compounding effect over 20 or 30 years within a tax-free or tax-deferred growth environment results in a net worth that is substantially higher than the same investments held in a standard taxable environment. This phase is where the strategic allocation of different assets across your accounts becomes an advanced financial discipline. You should consider placing higher yield, higher taxed investments like dividend-paying stocks or bond funds inside your traditional IRA or 401k, while keeping high growth, low dividend assets in your Roth accounts. By organizing your assets in this manner, you minimize the overall tax drag on your total portfolio, maximizing the amount of compound interest that stays inside the system. Managing your wealth in these accounts creates a highly efficient machine that ensures more of your hard-earned money remains working for your financial freedom in the future. Part 5: The Financial Freedom Stage. Living off compound interest and managing millions. Reaching the financial freedom stage means your investment portfolio generates enough passive income to cover your living expenses, effectively allowing you to live off compound interest without touching the principal. At this advanced level, your primary objective shifts from aggressive capital accumulation to capital preservation and strategic distribution. When your net worth reaches the millions, the scale of your returns changes entirely. A conservative 4% withdrawal rate on a $3 million portfolio yields $120,000 annually, which is well above the median household income. This phase is characterized by the optimization of your cash flow, ensuring that the passive returns from your investments consistently outpace your yearly expenditures, even when accounting for inflation. To make this stage sustainable, you must transition your asset allocation toward a combination of dividend-yielding equities, fixed income assets, and real estate investment trusts that provide a steady stream of cash flow. Relying entirely on capital appreciation during retirement can be risky because market downturns might force you to sell shares at a loss to cover your living costs. By structuring your portfolio to produce organic yield through interest and dividends, you allow the underlying capital to remain invested and continue compounding in the background. This cash flow-driven approach insulates your wealth from short-term market volatility and provides peace of mind, knowing that your day-to-day lifestyle is funded by the productive assets you spent decades acquiring. Taking actionable steps at this level involves creating a formal withdrawal strategy and setting up a diversified income bucket system within your brokerage accounts. You should keep 1 to 2 years of living expenses in highly liquid, low-risk instruments such as treasury bills or high-yield savings accounts to protect yourself from immediate market corrections. The remainder of your capital remains invested in the market, continuing to compound and replenish the cash reserves over time. Additionally, you must work closely with tax professionals and estate planners to optimize your tax liabilities during the distribution phase, ensuring that withdrawals from your traditional retirement accounts are done in a way that minimizes penalties and keeps more money in your pocket. Managing a multimillion-dollar portfolio also requires a shift in how you view risk and legacy, as the responsibilities extend beyond your own immediate financial needs. At this stage, compound interest can be used not only to maintain your lifestyle, but also to build generational wealth or support philanthropic causes through trusts and family foundations. You must regularly review your asset protection strategies, including umbrella insurance policies and the proper titling of your accounts, to shield your assets from potential legal liabilities. By institutionalizing your wealth-building systems, you ensure that the compounding engine you started as a beginner continues to operate for decades, securing your family tree and leaving a lasting financial footprint. Understanding how compound interest works at every stage of your financial journey is the ultimate key to transforming your financial future and achieving lasting freedom. Whether you are taking your first steps with that initial $1,000, accelerating your growth through consistent contributions, crossing the six-figure mark, maximizing your tax-advantaged accounts, or living off your wealth in retirement, the power of compounding is available to anyone willing to apply these principles. If you found this video valuable and want to continue building your wealth, please make sure to subscribe to the channel so you never miss our upcoming financial strategies. Leave a comment down below with your favorite quote or takeaway from today's video. I would love to read your thoughts and hear about the level of compound interest you are currently on.